I believe we're at episode 100 today, April 8th, 2022. We're thankful that you can be with us. We are not doing the COVID news today. We said we would stop at episode 99. We hope that that was a good decision and that that's not something we're going to need to track in the future. But it has been good to have this record of what happened here in the state of Michigan over the course of the pandemic. Of course, how this originally got started, talking about what was happening in the state with efforts around the state. Looking back at that, what a wonderful effort everybody made together. So thank you for that. We're going to talk just a little bit about some local news. There's a lot of events coming up this spring, summer, and fall, and I want to tell you about a few of those. And after that, I am joined today, I'm so excited, I am joined in studio by Dale Grogan, who is the managing partner of Grand Angels and the Michigan Capital Network. We're continuing our early stage funding series. And we've been talking about state funding and regional funding, local accelerators. Today, into the wild world of angel investing. It's going to be a lot of fun with Dale here in the studio. But before that, let me tell you about a few local events. This Saturday, April 9th, that's tomorrow, 10 a.m. to 2 p.m., the student teams from M-Heal would still love to see you at the M-Heal External Design Review Rackham Auditorium tomorrow, May 17th and 18th. The now Midwest Growth Capital event, Dave Brophy mentioned that's still happening, and they would love to see you there on the 17th and the 18th. That if you just scan that link with your smartphone, it'll take you right to the MidwestGCS.com webpage. Come on, take a look. They are friends at MishBio. They want you to save the date. This is worth knowing. Tuesday, September 20th, 2022. It sounds like it's going to be live in Kalamazoo, the Michigan Medical Devices Summit. It's good to see that getting going again, because a few years ago that was just really hopping. At that summit, there have been various heads of FDA or heads of FDA divisions, not to be missed when that thing is charging full steam ahead. So hope you can make it September 20th. Also this, Capital Days, April 29th and May 6th. This is actually how I really got my first exposure to MishBio, was going up to Capitol Hill and getting to intriguing, really fascinating as somebody engaged in this business. And I'd say not to be missed. So April 29th and May 6th, through that link there, you can get connected. Also, the A2 Biosocial is back. April 13th, they're no longer virtual. They will be at York, 4:30 to 6:30 p.m. On the 13th of April, Wednesday, April 13th. I would love to see you there, but I will not be there at the Biosocial. I will be in Anaheim, California, sunny California. At least I hope it's sunny. I hope it's not pouring rain. Because the folks from MEDC have bought a booth. The state of Michigan has bought a booth, 20 by 40 booth, at the Medical Device and Manufacturing West Trade Show. And they've offered kiosk space to a number of Michigan MedTech companies. Into Being will be at that show. And we said, as long as we're going to be there, why don't we make a documentary of all the Michigan companies that are going to this trade show? And they said, hey, that's a great idea. So next week on MedTech Crossroads, we're going to have a special episode where we'll be doing coverage of the MD&M West trade show. And if you have any questions about vendors who are there or those sorts of things, feel free to shoot them to me. We'll be walking that trade show floor, and if there's a way that we can make introductions, we would be happy to. Well, that brings us to our main event, and that is the continued early stage decades just to help everybody move forward. This is a real investment. This is a real time where we're taking our own money, because angels are generally coming to the table with their own money to put it into a company. So it's a very special inflection point. Tell us a little bit about yourself. Who is Dale Grogan? What makes you, I'll use the word crazy enough, to keep coming back to this game, to keep coming back to such a high-risk endeavor, to bring these startups, to evaluate them? I think you told me beforehand, you've been in some 15,000 pitches, and you've only ever seen 2 perfect ones. That takes a lot of just fortitude to sit through that, Dale.
Patience.
Patience.
Right. That's right.
Who is Dale Grogan?
Oh, golly. Well, like every young person, I had a perfect plan as to what I was going to do. It was all mapped out from the time I was 9. And I was going to be an eye doctor.
Really?
Yeah. And then I got into optometry school. and decided that was not the plan after all.
I will say you do kind of have the eye doctor vibe. I could see you
I don't
with
know
those little paddles,
which is better,
sort of
one or
staring.
two or three, three or four. Yeah, I couldn't. Well, that was part of it. I couldn't imagine the repetition of that,
Yeah.
and just doing that over and over and over again. So, to your question, why? My inquisitive nature. You want to learn more. You always, there's this sort of unquenchable thirst for knowledge. That's part of what makes a good investor, I think. But I left optometry school in '87 and started. Yeah, that's how old I am. And started with Merrill.
It doesn't
Lynch.
show. You're doing fine.
You're kind. Started with Merrill Lynch on Black Monday. That was an auspicious day in the market, and so went through all aspects of finance, for everything from retail to investment banking to M&A to investing, and then into venture. So I've sort of seen all aspects of it, and oh, by the way, took a sort of sabbatical to start up and run a company,
Wow.
a tech company, took it private, took it public again, took it private. It was just a lot of different things. But I think the point is having a holistic view, having been on every side of the table, gives you an informed perspective and maybe a little bit of empathy for the person across the table, you know.
Yeah, you've sat in enough of those seats that you're not surprised by anything that could be a pressure or a need on any one of those.
I think that's fair to say.
That's so cool. And then to come back and to keep doing that and to keep looking at these things. Tell us about Grand Angels and Michigan Capital Network. What are you guys doing there?
Such a great story. Gosh. So this started, the Grand Angels started about 18 years ago when several successful business people came together and said, we want to be investors for the purpose of investing into local businesses in the community. Not an unusual idea, but one of the first times it had occurred in sort of a formalized fashion in Michigan. And so this group came together, and they were smart enough to hire a person to manage that organization, Jody Vanderwell. And she really must be credited with growing the organization and corralling these cats together to make investments. And so the Angel Network grew in Grand Rapids, and then over time, there were some affiliation capabilities and opportunities. So now, fast forward 18 years, Michigan Capital Network is bifurcated into the angel side, which has 5 angel groups. So Grand Rapids, Kalamazoo, Flint, Detroit, and Midland. That's 180 angels.
Wow.
And then on the other side of the house is the venture funds. And so those are organized, managed venture funds. On top of the entire organization is a 501c6. Whose purpose is education, investor education. So that's how it all comes together.
Wow. Well, of course, near and dear to our heart, teaching people about whatever discipline you're in. And I always like to say the price of publicity is education. So we're thankful that you're willing to spread that education around and tell us about this process. I know I've encountered in my travels a lot of angels who, how to say this generously, maybe shouldn't be angels. They've got some extra money. They think, I'd love to get into this game. I've got an extra $50K. I'm going to make 2 25K investments. And my friend over here has this this great idea that they told me about over coffee. And you often feel bad because it's like, wait, hold on. Something's not right here. And I'm not an angel investor. But you said you got 180 angels. You've banded together. You guys are sharing information. We're not talking the person who just saw this over coffee and thought, I'll dump some extra money on this. We're talking much more professional, much more, there's a process here. And before we talk about that process, I guess, Dale, who should be an angel investor? Is this the kind of thing where if I've got an extra 25K, I should think about investing in a company?
I don't know that, but I can tell you, if you want an alternative to the market, right? So you have public equities and you have private equities. That's sort of how the market is sort of segmented. And it used to be, when you would go to your stockbroker years ago, it's 100 minus your age equals how much you should have in debt, right, in bonds, and the rest is stocks. Private equity didn't exist, and it didn't exist because there was no access to it. That was the domain of hedge funds, pension plans, and ultra-wealthy people. Fast forward, now there is access to private equity. And private equity means sort of buyout funds, mezzanine funds, venture capital, commodities, gold, real estate. So it's a broad band of alternative investments. That's the other word that's always interspersed is alternative investments. So you should consider that as an investment strategy. To do that, you ought to be thinking about a percentage of your investable net worth. Anywhere from 5% on the conservative side to a third if you're more of a risk taker and younger enough to be able to absorb the time risk involved too. So it depends on your net worth. What I would say, however, is you must understand that angel investing in any illiquid asset takes time and it takes diversification. Do not expect to make 2 investments and have 2 home runs.
Yeah.
The math is against you.
Yeah.
So that's what you have to consider.
And of course, the rule of thumb was always, oh, 1 in 10 works. You always hear people say that, and it's not clear to me, especially in high tech or health tech, like not even clear to me that that's even a fair number. I don't know what your thoughts are there.
I can tell you that from a venture perspective side, the math is of every 100 deals that are reviewed, and that gets into actual diligence.
Yeah, we paid attention to you. We didn't just
Right, not just no,
say, okay,
no,
yeah.
no. It's a maybe.
Yeah.
Of 100, 1 gets invested.
Wow.
So it's 1%, and then of that, 1 in 10 makes all of the money for the other 9. So it's really 1 in 1,000 are the ones that you talk about.
Wow. Okay, that
It's
you
pretty
just
sobering.
dwarfed my number by
It's pretty sobering.
rather large
Yeah.
large factor. And of course, you've sat through quite a few of those pitches over the years. Okay, but what I'm hearing here, and actually it raises a question too, because I've heard that increasingly even venture capital firms are finding investment in themselves from like pension plans and things like that, which is just a diversification strategy then at that point. So
It is.
This is
Yeah.
the highest risk stuff we can probably do. We'll take a little bit of that depending on, now not the age of the person so much, but the age of that pension fund, I guess. That's the criteria there.
Sure.
Okay, really interesting. So maybe one question here would be, who comes to Grand Angels? What's a typical angel investor that might come and join your 180? Who's going to be the 181st angel investor?
Well, it's interesting because over time it shifted a little bit. I don't know exactly what the number is, but the average age has dropped.
Oh, wow.
Which is exciting.
Yeah.
Right? Originally, it was this sort of small country club group of white men.
Good old boys club.
It's exactly what it was. Let's call it for what it was. And now what we're seeing is as wealth is created faster, you're seeing younger people investing, and you're also seeing a greater awareness to alternative investments. So an investor might be somebody a new angel, might be somebody in their late 30s, early 40s, successful, and is creating wealth as compared to somebody who had already achieved wealth. So being an angel investor is now seen as an investment strategy, not the outcome of having made your money already.
Interesting. So they're still sitting there. Their careers are still on the ascendancy. They're still making money, and this is just a place to put some of that. Wow, that's really interesting.
And that's really, really cool because what you're starting to see is activism, and when you see active angels involved, that increases and creates better outcomes for everyone as investors.
Because now they're investing not just their financial resources, but their expertise and their connections. They're all very live and hot because they're running businesses themselves.
That's right.
Wow, that's really cool. So it's really becoming something that we're not just relying on sort of money that's been sitting there for a while. We got all the expertise that's coming through that door.
That's right.
Now, it strikes me that what you guys are doing is, in some ways, also a refinement. I've heard of like angel groups getting together, and it's more a coffee club, like we get together on Saturday and we talk about some things. And is that sort of a primitive form of what's going on here, where a group of angels might just get together because they know each other and they happen to have conversations? Seems like that might be a sort of a precursor of what we're talking about here. There's more formalization of this?
Yeah, I think that's right. I think that Michigan Capital Network has sort of evolved, and I love the direction of it. As an example, the organizations get together once a month, and they're hearing 2 or 3 pitches, which is a lot. But the pitches come pre-vetted. So it's not like you're an entrepreneur and you call up somebody at one of the 5 Angel networks and say, hey, I've got an idea I want to pitch next week. It's not how it works at all. So they have to go through a process. Each one of the 5 affiliates has a director, and the director does the initial vetting.
Wow.
And so for somebody to get to be able to pitch to the group, all 5 groups, they have to be vetted, and there has to be some diligence that started. Here's the benefit. As an entrepreneur, if you get on the docket, you're pitching to 5 angel groups live, 180 different investors.
Wow.
Now imagine that as compared to driving all over the state for 25 grand a throw, having 180 meetings.
Yeah.
It's extraordinarily efficient. And what you find out is if you're able to get through this and you get investment, the level and the sophistication of the investor in the investment is raised exponentially. It's unbelievable.
That's amazing. It's quite an opportunity. It also strikes me as quite a danger for the company. I mean, you're getting in front of 180 angels. You're also getting in front of 180 angels who all know each other and represent a massive chunk of the community.
You have to be ready.
You got to be ready.
You have to be
wow.
ready.
We're going to talk a little bit about that, I think, in a little while here, is what is readiness for something like this? Because there's a lot of startups out there and they're asking the question, what kind of capital can I access? And we've talked about some of that on the show already with the state and stuff like that. And those are often, I mean, they're not without scrutiny, believe me. They've got a lot of scrutiny. But there's the potential that, okay, this is very, very early stage, but now when I come in front of this angel network, it's actually very high stakes, because how you make that first impression is going to affect quite a few people across the state. You're not going to easily find other angel investors who are sitting on those sidelines.
That's right.
That's kind of incredible. Well, let's go into the seat of the angel investor. I want to talk about the startups later and what they should be thinking about and how they should think about this process before they approach a group like Michigan Angels. But if I'm sitting in the chair of the angel investor, what does my life look like? I think you told me the other day you kiss a lot of frogs.
That's one metaphor. Yes, you do.
What should an angel investor sort of expect? You mentioned diversification earlier, that you're not just going to put money in 2 of these and expect it to go somewhere. You also talked to me previously about, we're not really country club investors here. This isn't just a hobby. There's a discipline behind it. But what does the cadence sort of look like? How often might an angel expect to find something that they're going to invest in on average in your process? Is there maybe there's no norm there, but what does life look like from their seat, I guess, is the question.
So how an individual angel curates their portfolio is up to them. What we at MCN provide are opportunities to invest in what we would consider investable deals. Right? So if you're...
This is where the pre-screening comes in.
That's right.
Happened, yeah.
That's right. So if you're an angel investor and you're a kazoo angel, you'll see 2 deals a month. This next month, we're actually looking at 3. Wow. Because we happen to have some follow-on opportunities, which are tremendous. But that doesn't mean you are obliged to do any of these. A good angel investor will try to bring knowledge to the table. So if, for example, I ran a MedTech firm, I probably know more about that than investing in that space than I do in consumer branding, right? So a good investor will tend to gravitate towards things that they know and things that they like. But I will tell you, of the 180 investors in the network, there has not been a single time when we've brought a deal in front of the group where somebody hasn't said, I know that space. That is so extraordinarily powerful. You have no idea. Because you know which questions to ask. And you and I talked about the known unknowns and the unknown unknowns.
Yes.
So important. because a good pitch will point you in the direction of where the CEO wants to take you. You know, you think about that competitive analysis in every pitch deck. Check, 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 check. Well, of
That
course
matrix, of course it is.
Exactly,
Yes.
right. But do they have everything on there that's relevant to the business? Maybe not.
Yeah.
So knowing which questions to ask is what makes you a really good investor.
Yeah.
And so if you have those people at the table, it doesn't have to be you, but if you have that in your cohort, so much the better.
Yeah, and now it's diversified in a way that the person who knows about the space doesn't even have to invest in it, but they're going to benefit the people who now have a choice as to whether they're going to invest in it or not. So it's sort of split up at that point. You've got this power.
That's right.
And choice. That's really cool.
So let me just add one more comment. So as an angel investor, if you decide today, I'm going to be an angel investor, I have X dollars, whatever it is, don't do all of your deals in 1 month, right? Because there are economic risks, right, in terms of valuation and pricing, and in companies going through downturns, and depending on cyclical economies, those all matter. Pace over a period of time. Build a portfolio of 10, 15, 20 companies. That's a smart way to do it. And by the time you get to your 20th company, if things are going well, or at least average, you should be recycling some of those investments. You should have some realizations, right? So that dollar in should generate $2 or more out. And that's how this process continues. And that's how you have sustainability and longevity as an investor.
But you, in your choice of when you invest, you've sort of got to decide, am I going to do this? I mean, you could dump it all in one, but then you're just waiting, and you have this very cyclical thing. But if you can spread those out, even the timing of those deals out, I think what I hear you saying is you can create stability for yourself. And then you're not waiting on 7 deals to all come, hopefully, fingers crossed, they all work at one time. You're taking them one at a time as they mature.
That's right.
Yeah,
That's right.
That's huge. I guess a question that comes to mind too is, okay, so I'm a high net worth individual and I'd like to get into angel investing, but I've always done it myself, and I'm going to go it alone. Now, your answer to me before was interesting. It sounds like you're not totally against somebody going it alone. I mean, sure, it's your money. You can go take your choices. Should anyone go it alone? Is that something that, I mean, obviously we're sitting here, we're talking about a group that is well matured and well positioned to help angels cooperate and to find deals. They're under no obligation to take those deals. It's not like you're pooling your money and throwing it in and voting on it or something. But should anyone go it alone? Is there anyone for whom that would be a better choice?
Well, that's certainly an individual choice, and I am admittedly biased, right? But I would tell you that there are groups that do that, right? And they become family offices, right? And the one thing that every investor must have is support, whether it's even tax support to prepare the K-1s, right? Or it's shareholder support, or it's legal support, or accounting, or whatever. The list goes on and on. Certainly, individuals, if they understand the space and only want to do that kind of investing, the MedTech example that they gave.
One vertical there.
Sure. Absolutely. That makes perfect sense. I would tell you that diversification is certainly better. But make no mistake, just because you've been successful in one area doesn't mean you're a captain of industry in all areas. We've seen that many, many times. I'm a rich guy, I made it, look at this, I'm obviously smarter than the average bear. I'm going to go put my money in, I won't say a company, for example, but in a technology that doesn't work. Yeah. Or something like that.
Or there are roadblocks. We've seen that so many times from the development perspective. People will come and they'll say, I know what I'm doing, I've got the money, I've been successful at this product. Was it in a regulated industry? No. Oh, well, you're in a regulated industry now. Welcome to the party.
What's an FDA approval process look
like?
Yeah,
exactly. No, never touched it.
Yeah.
I will say, though, I feel like we're seeing more, just to give some credit to the community, I feel like we're seeing more transparency and more humility out of folks. They know what they don't know much more of the time than I feel like even 10 years ago was the case. I don't know how you've seen that, if you've seen maturation in the kinds of deals that are available to you? Do you feel like there's more self-introspection, analysis, more humility coming out, or is it still?
No, I would say the process is certainly much better.
Yeah.
Individual humility, I can't speak to
Mm-hmm.
that. I've seen both ends of the spectrum.
Yeah, certainly. Some come knowing what they know, and some come knowing what they know but asking good questions along the way too.
And then there are those that are insistent that they know
Yes.
and are wrong. We've seen that too, right?
That whole question of can you take the heat? Can you take the questions? Can you rationally evaluate in a way that other people who happen to be your stakeholders at that point can acknowledge that you're doing this analysis well?
Yeah.
Yeah, that's huge. Well, you guys have a process for this. Before we talk about where angels normally invest, and before we talk about like what makes a good pitch deck and things like that, which I know our startups would be very interested in, how should I think about putting my information together for you? Tell us about your process. You do this scrutiny. You have a disciplined approach to it, but it's still the individual angel's choice as to whether they're going to invest in something. What sorts of scrutiny are you putting people through before they can even walk into that room? What's that look like from the perspective of a start? So we're not talking about the details of the pitch deck yet, but we're sort of saying what hurdles or doors are going to have to open on the way into that big
How do I get
pitch?
to the show?
Yeah, how do I get to the show?
Yeah, great question. Well, first of all, it starts with a cogent story, right? You have to be able as an entrepreneur to articulate your story on the spot, right? In one breath. What do you do? I make micro springs that fit into catheters that are, the market is this big. Great, I understand that. Yep. So you have to have the story well reasoned and well told. It may not always be right, just like projections. They're never right, ever. But the story has to be logical and defensible. So that as an investor, if you say, well, why do you want to do it that way? Well, because manufacturing rules say blah, 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 blah. Oh, okay. Why are you going to go direct to the consumer? Because the FDA says we can't do it any other way. Okay, I understand it. So there has to be defensible answers. And you have to demonstrate that you've not only thought through the business, but what the implications are for an investor, right? And there's a real difference between understanding a product and understanding a business. Oftentimes we see in sort of these speed dating pitches, young entrepreneurs or first-time entrepreneurs might come in, and if they have 8 minutes, they'll spend 6 minutes on the problem. The market really needs this, and the market says this, and we really believe that this is an untapped potential, and so we've unveiled this left-handed widget. And they talk about this for 6 minutes, and then in the last 30 seconds, it's, yeah, we're going to raise $5 million, and we think it's going to be a great deal. That's the stuff that I care about. Jack Aarons is a great venture investor. He ran TGAP for years and years. And Jack said, when the entrepreneur goes on and on and on about his product, Jack says, let's just assume it works. Tell me how I make money doing that. The truth of the matter is, back to that comment about perspective, the investor is looking at, let's be honest, the investor is looking at you as means to an end. The end is making more money. I give you $1, you give me back $3. If I've made 3, you've made 5. Good for you. But that's our transaction. And if it's not you, there are 99 other people behind you. That's how that works. So don't assume that we're there because we love left-handed widgets. Don't care about them. Care that we can make money from them. It's probably harsh to say it that way, but that's kind of the reality.
I think when it's honest and on the table, it's fine, right? And then people can pitch what they want to pitch, right? I think it's always the misaligned expectations that are so hard to deal with, in both directions, right? If you don't understand what your investors' expectations are, if the investor doesn't understand what yours are. I remember a conversation was had with an individual some months ago, and the individual said, I've got this idea for a MedTech product, and I want to make it and I want to flip it and make a bunch of money so that I can go and do what I really care about.
Goodbye. Next.
And
Wow.
it was like,
Not a good pitch.
we did some education at that point
Wow.
in the process, because it's just like, no, I'm going to save you the heartache, right? Like this is not a good fit. We're not gonna succeed to bring something to the market that we care about, and you're not going to succeed. You're not going to make that thing. I mean, I hope that you can go out there and make some money, but this is not the way that this process works. And so to get those alignments of vision, shall we say, along the way is so important.
And sometimes the investors can bring the sobriety and perspective that the entrepreneur just can't see. They're so blinded by their own vision. It's sort of the old Spinal Tap scene. But it goes to 11, like, great. That's awesome. Now what?
Yeah, now who cares? What's the reason?
Right.
It's interesting you talk about it that way, because you said focus in the pitch, and we're going to talk here about pitches in just a second. But you said in the pitch, don't spend so much time talking about your product. Talk more about how is this process actually going to work? How are we as a business going to make this work?
That's right.
Tell me, because we had a series on market discovery earlier. And I think one of the sort of points of self-humility and humility of many that we talked to was you can never do enough market discovery. Now, it's distinguishing from what you say in the pitch and where you spend your time. I guess how much about the market do you want to hear? What does it take to convince you that they've done that homework? And we'll get to the rest of the pitch here in a second.
Yeah, it's so important. Being able to understand your market is crucial, and not overestimating it. So if you said, I keep going back to medical devices. If you say, look, we created a new catheter, to say the total addressable market is all healthcare spend is not right. To say it's cardiology with catheters that sort of solve a coronary stent problem that was heretofore not available. Okay, now we're talking about that. And so you're able to articulate that you understand where the market is. And so that is one of the important pieces. The other part is understanding sort of direct and indirect competition, right? Indirect competition could be we're just not changing status quo, right?
So many times you hear that, right? Oh my goodness.
Overcoming inertia is a risk,
Yep.
right? But this thing sells itself. Nothing sells itself. As soon as we do this, people are going to just order these things like crazy. Nope, that doesn't happen either. So the idea of being able to understand where the market is, who your competitors are, and finding your niche. It doesn't have to be giant. It just has to be defensible.
Yeah.
Right? If you found a new way in, and you found some white space or blue ocean or whatever, green, blue sky, pick a color. Right? Doesn't matter.
Favorite color, whatever you want, just make it wide.
Right? Yeah, just in rainbows. Whatever it is, as long as you can say, "This is how I can do this," and if someone asks you and says, "What about company X?" Well, they compete over here. A prepared CEO who understands his market is worth gold because it's really rare.
That's huge. I think I just heard you say something that I want to highlight. I think you just told me, hey, startup CEO, you don't have to walk through this door promising me $1 billion market.
No.
Like a lot of times they do think that. They think that unless I can talk about $1 billion market, or unless I can somehow argue that or argue for some expansion to that, then I'm not worth my salt. I shouldn't be doing this. I have to argue that.
That's a natural temptation, isn't it?
Yeah.
That's not it. The math that investors use is I have to have the ability to envision at the early stages, sort of at the angel stages, a 7 to 10x return.
Okay.
Okay, so that's the math that I'm thinking about. So that's 7 to 10x on the value of the company at exit. If it's only one round, which is never the case, if it's only one round, and your pre-money valuation, that is where you invest, the value of the company when you invest, is at 10 million, that means a 7 to 10 is 70 to 100 million. A lot of companies exit very successfully at 70 to 100 million dollars. So that's okay. That's nowhere near $1 billion.
Yeah.
But if the company needs 2 or 3 rounds of funding, if round 1 is a couple $1 million, and round 2 is $5 or $6 million, and then round 3 is another 15 million, you're $20 million in of invested capital. Selling at 100 is just at dollars in. That's only a 4. Well, that's not nearly as good. So it's really about how many dollars in versus how many dollars out. And that's kind of the calculus that you think about. So as an entrepreneur, being able to say, this is how much money it's going to take me to get to various phases, including the exit, right? Because always begin with the end in mind, right? If you need $25 million total, that's what you ought to be telling your investors.
And oftentimes, I've watched as people get dinged, not estimating enough to really get to that end point. It's like, we think we can do this efficiently. Well, that's great. I love saving money, but are you actually going to get my money across that finish line?
That's right.
Okay.
That's right.
a thing. Interesting.
And if you don't, well, guess what? You get penalized.
Yeah.
Because the investors will just hammer on value. You did not deliver. I'm willing to give you more money, but it comes out of your pocket.
That's a really important point of transparency. I think that's something that, go back 10, 20 years, I feel like there were lots of entrepreneurs in the community who didn't understand that aspect. And it's like, yeah, if you can deliver in what you've said, the deal's going to look like what the deal's going to look like. But if you fritter away this money, you're going to end up, yeah, you may get more if there's still a good argument there, but it's going to dilute that valuation, and it's going to dilute your ownership percentage of that. Yes. I think sometimes it's like, okay, just register that, right? Like, just as an entrepreneur, just register that.
But you said it was going to be. Well, you're right. And again, that goes back to the nature of the relationship. You might become friends, but it is still transactional, right? You set expectations. I'm willing to give you money in return for those expectations. If you do not meet those expectations, then the trade changes.
Yep.
And that's just the nature of the transaction.
Yeah, that's the business relationship there.
It is.
Well, let's talk about these startups, and they walk through the door and they make it through, and they.
Yeah, I love
I should say, what door do they knock on first of all? If there's a startup that really says, I think angel funding is the next for me, and I want to talk to grand angels and.
Great. Yeah, just go to MichiganCapitalNetwork.com.
MichiganCapitalNetwork.com.
Yeah, there's a plug right there.
There you go. There it is right there.
Yeah, and so what you'll do is you'll talk to one of the directors or talk to any of the angels, right? If they're in the network. That's often the best way to do that, is a warm referral in.
Yep.
It's very difficult to knock on the door and say, hey, I have an idea, would you listen to me?
Yes.
Yes, it occurs, but it's often much better if one of the angels who already sort of understands the process has said, hey, listen, I talked with Gary, and Gary's a good investor, and Gary, sends us an email and said, listen, you really ought to listen to Gene's pitch. It's pretty good. Here's the deck. Okay.
Now I'm listening. Yeah.
Because one of our members has said, kind of like it.
Okay. Yeah, that's good. There you go. MichiganCapitalNetwork.com.
That's it.
People can get there. Well, let's talk about this pitch. So we talked a little bit about. Doesn't have to be $1 billion market. Oh, and I got to keep track here because I think we might have a couple of. A note from Kevin saying, thank you for discussing spend, and goes back to marketing 101. So I guess I must have mentioned that earlier. We've talked about the importance of identifying your market and the importance of not belaboring the solution in the pitch itself. Now, we're not saying don't understand what your solution is, but rather the relative weight. What other sorts of things would you say? Maybe we can sort of hit highlights here. You said you've seen, I think, 2 perfect pitches in your 15,000 or so. So either the positives or the negatives, however you want to talk about it, but either the things that you just wish you could tell every pitch to get right, or please focus on this, or the places where you can really call out and say, when I saw this done best, they touched on it this way, and they say, what are the important parts of a pitch that are often gotten wrong?
Wow. Oftentimes, It's exactly what you said, Gene, about this idea that you have to have the next blockbuster, whatever. That it has to be a unicorn or bust. Not the case. So the elements of a good pitch, you start off with the team, right? It's always the team, always, always, always the team. A plus team, B plus product is better than a B plus team with an A plus product. Always.
Because you're not going to get there if you don't have a team that can execute.
That's right.
Okay.
And as we talked earlier, if you have to pivot, the intellectual horsepower of the team is what matters, is what allows you to see the battlefield and pivot. So team, 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 team. Right? So your pitch is, this is who we are, this is what we've done before, this is a problem that we've identified, and here's the solution that we're proposing. Right? So that's where it starts. So it's the team being able to say with authority and confidence, we've found this because we've been in the space, and no one else is doing this because we know the space, and here's the innovation that we've created. And the phrase that people often use in investing is revolutionary versus evolutionary. I want the quantum leap. I want to go from horseless carriage, right, to car, or horse to horseless carriage, right? And the great quote from Henry Ford was, you know, if I listened to my customer, I would have built a faster horse, right? So innovate, right? Do something differently, and it doesn't have to be the best of the best of the best of the best. If it's something that is a stopgap, but it grabs the first market, that's okay. If you can be the early adopter, and then someone can buy that company and iterate beyond that, that's fantastic.
I don't know if I'm still allowed to use this example. I think it's too late now. I've dated myself, but VHS versus beta. This has been the last time ever using that one, right? But it was a better technology. Beta was a better technology.
That's right.
But those who remember those kinds of technologies, yeah, right there.
Right.
VHS took over and won, and you know,
that's right.
Eventually, it went the way of the dinosaur. But still, I think it's kind of what we're talking about.
That's exactly right. So you have the team, you have the market, and then you have the business model, right? How am I going to make money? And how is that defensible? How am I doing this when no one else can do it? What's the competitive moat, right? That's the phrase that people always use. So what can I do that nobody else can do because I figured it out either better or first, right? And around that competitive moat is the ring fence of intellectual property.
Yes.
Right?
Yep.
I have patents, I have know-how, I have the secret sauce that no one else knows how to do, right? That's astonishing. If you can do that, and oh, by the way, patents in certain categories matter a lot, life sciences, or they matter very little, software, right? That's where
you can hardly get them to start with, yeah.
That's right. Yeah. So being able to say, this is how I make my money is important. And then you move into the financial aspects of it. This is what it's going to cost to get to these various thresholds, right? To get my first product built, to get my first sale, to get traction, whatever that looks like, to get to version 2, right? To get a strategic distributor, and then maybe to get to exit or whatever. So being able to identify those thresholds with time and money is crucial, because you want to say to your investor, look, if I'm building a new widget, Rev 1 is going to take me $1 million in 6 months. Investors here, $2 million in 12 months.
They're doing the doubling.
Double it up, right? So you do that, and then if you're able to get your first sale, right? That's what you want to do. So when you're going out as an entrepreneur and looking for the amount of money you want to raise, make sure it gets you past a couple of verifiable, completely objective thresholds. I built product 1, it came off the line, and then I sold it for this price.
Yeah.
Verifiable, not anything like, we're making progress. No good.
Yeah, doesn't sell.
Doesn't sell. So you raise enough money to get you past that threshold, and then you're able to raise again, because the best time to raise money is after you've delivered on what you said.
Absolutely, yeah.
That's when you do.
That's huge. I think people and of course investors will sometimes tranche the money
They
such
will.
that you can get more of those milestones and show finer granularity on that
That's right.
process.
Yeah.
It's actually a place where, just going back to some of the earlier funding mechanisms we talked about, I've been pleased that sometimes, those are not free money either, and oftentimes they will even tranche some of these state or local things. They'll even tranche and say, yeah, that first dollar is pretty easy to get, but that second dollar, did you execute? Did you do what you said? And
It comes with strings, and they're appropriate.
yeah,
They should be.
it's a good training as they're getting these training wheels on the thing. I want to make sure we get to a couple questions here that just came in. One from Richard: what are the pros and cons on angel investors versus family offices? You mentioned the family office model, especially if you're going it alone and going in a particular vertical. Yeah, so we're thinking as a startup now. What should I be thinking about a family office? Should I be thinking about an angel? When should I be thinking about one or the other?
Boy, that's a really nuanced question. So thank you, Richard, for that. So if you're an entrepreneur, when should you go to, let's take a family office first. Yep. You should go there when you have something that is viable, where the story starts to hang together. Assume that these are sophisticated investors.
Yeah.
If it's a family office, they are now in the business of investing.
Yeah, they hired some people, and they this is their job now.
This is their job. So they're no pushovers. Oftentimes these come from personal relationships. Happen to know one of the members of the family, and you see that a lot of times. And so the pro with going to a family office is you only have one person to sell typically in the family office, and there is oftentimes, not always, but oftentimes a less stringent hurdle to get over. If they know you, if they like you, there's probably less diligence that's involved, for sure. The con is if you go to one family office, you've been to one family office. And unless they are going to be your sole investor and going to write a 7-figure check, then you're still going to have to head down the fundraising trail. Now, if you get that single investor,
Maybe worth it.
but you're also married, right? And for good, bad, or other, right? Because there is some value in a diversified cap table,
Yep.
right? Because if you have a single family office and that person's on the board and things are not going as well as you thought, those are some very tough conversations. And it's one-on-one. It's not sort of, we have the ability to sort of spread risk from the entrepreneur standpoint. So
Sometimes having a lot of investors means you've got to do the due diligence with each of them, not the due diligence, but the keeping them updated on what's happening. But on the flip side, if you only have one, you're almost bought and paid for by that one.
It's so there are goods and bads. So going to a network, if it's run well, and MCN is, I can say it because it's not me, right? If it's run well, the communications is very, very easy, right? So the entrepreneur talks with some members of the MCN team, and then we distribute out information on a
wow, so they
basis.
don't have, that's actually an interesting point. They don't have to manage all their individual angels at that point.
No. So if you are a member inside the MCN network, you get a quarterly report. This is what you're invested in, each one of these individual companies. If you're in a fund, here's how the fund's doing, and here's your capital accounts.
Wow.
That is very, very useful in terms of tracking, because if you're an individual investor, going back to the go it alone, that's a lot of work. Imagine if you are in 15 companies, and there are 15 quarterly board meetings, and financial, and capital calls. It's a lot of work.
And we've heard startups not complain, but just say how much work it is that they've got 30 angels in them, and they now have to deal with each of them, and they should. They're stakeholders, deal with each of the opinions and preferences and everything else of 30 people. It takes time.
Yeah, the realization for the entrepreneur is once you take somebody's money, you have an obligation to them to report, to be truthful, right, and to be timely. Right? You can't just say, I took your money in, I'm going to give you your report next year. That's not the expectation. Right? You now are obliged in both directions.
Yeah, I think a lot of times owners need to understand that when you've taken that investment, you are selling a part or much of your company. So it's a big step. Yeah, I'm glad we can touch on that. We've got another question here I do want to hit before the top of the hour comes, and that's from Ken. Safe versus convertible note preference. What's your opinion on safes?
Hate them.
Hate them. Okay. I've had other people say, we love them.
Hate them. Hate them. Right?
This is good. There needs to be a panel on this one. We can have some real knockdown dragouts. But
So now this is from an investor standpoint,
Okay, yep.
right? A safe is simply an agreement for future equity.
Yes.
Simple agreement for future equity, which means you're really not buying anything. You're buying a slot to invest in the future. Good for the entrepreneur. Very, very company friendly. As an investor, if I'm taking the risk,
Yep.
I want to have some sort of quantification of what I'm buying.
Yeah.
Now, they have shifted, safes have shifted more towards convertible notes, where there are statements of conversion rights or discounts or valuation caps. That the reason you do a convertible note anyway in an early stage situation is it's very difficult to come to an accord between the investor and the entrepreneur. Entrepreneur says, my company's worth $20 million. Investor says, you have an idea. I'll go 5. Well, there's no way I'll go 5. This is 20. So you just can't get there. So instead, this mechanism of these convertible notes or safes are, look, we're going to kick the can. When we get to a Series A or a Series B, a priced round, we will deal with it then. And the way that we will deal with it is in a safe. You get to buy in at that. No, thank you, because I already put my risk capital back here.
Yeah.
Or you get to buy at a discount or a cap or some sort of conversion, right? So that makes a lot of sense. Investors must be compensated for the present day risk that they're taking.
Yeah.
So to be able to say, look, so from an entrepreneur standpoint, it is a non-starter to say, after I get your money, I'm going to create value for you so that you'll then be at par. No, I'm investing today. So my dollars have to be representative of where the company is today. Not if things go really great in a year or two, then I'll be up to where the valuation is now.
Yeah, we're sort of ignoring the time value of money and the inherent risk of development in between then.
Yes, because you have all kinds of risk. You have startup risk, you have execution risk, you have capital risk, you have market risk. There's so much of that that's why 80% of startups fail.
That's really interesting. I have another question about SACE for you. Since we're coming to the top of the hour, I want to get in one more guest question, and then we're going to go, if it's all right with you, just a couple minutes past the top, because I have one more really important question. For those of you who can stay with us, that's great, and for those of you who can't, we'll certainly understand as 3 o'clock is rapidly approaching. One more viewer question from Vishu. How is the Michigan Capital Network process work and the timeline? So we talked a little bit about how to get through the door. Warm introductions are great. Go to michigancapitalnetwork.com. But let's talk about that timeline. So they've gotten the introduction, they're talking about it, but maybe a part of the question, we don't see it here, but maybe a part of that question is, I'm going to need that money. How quickly can I get to it? What's that timeline look like?
Right. Well, let's pull back the curtain on that a little bit. First of all, making payroll is not an investor motivation, right? So plan accordingly, right? Yep. 60 to 90 to 120 days. That's what we're talking about, from contact to funding, right? So let's say you get in the jet stream and you're able to make a pitch within 30 days. It's going to take time for the organization to do its due diligence. And the due diligence is everything from the market analysis that we talked about to understanding the CEO and the management team, what they've done, to going through and doing financial modeling, to doing customer calls. You know, there's a whole raft of work that has to be done. Once that's done, then the output of that, whether Typically, you see this in venture funds. The output is an investment committee memo, which is a standalone document that says, we've done all of the investigation about the key elements of the business, the team, the market, the financials, the exit modeling, the comps, all of that stuff. That takes a while to conduct. So 60 to 90 to 120 days is reasonable. It can take a lot longer if you as the entrepreneur are not having a lot of success raising funds. If you're raising money at a good clip, then FOMO occurs, right? Oh my gosh, you're about to close this deal out. We better get moving, right? But there's a natural sort of cadence. So I would say plan on 120 at the outside. If it happens faster because you have a hot deal, God
Great,
bless you.
Congratulations. Yep.
Wonderful for you. Yeah, we'll move as quickly as we need to.
I would imagine that it's not a terrible idea, even before you're ready to pitch to a group like Grand Angels, to know the people, to have communication, to say, hey, this thing is coming. We're not ready to pitch yet, but wanted you to know that this is there. Is that a fair?
That's the secret right there. You've hit it. The best way to pitch investors is to tell them what you're going to do and then deliver on it. So you could say, Gene, listen, I've got an idea. I'm working on a new startup company. Phrase is stealth, whatever. I'm in stealth mode right now. I'm going to come to you in 60 days, and I'm going to have a minimum viable product that I'm going to demonstrate to you. Say it's software.
Which I don't have today, but I'm going to have it for you in 60 days.
We're working on it because my tech team, and we've all done this before, right? Credibility point. We've all done this before. My tech team is ready, and then I'm going to show this to you. At that point, I'm going to ask you to sit down for a formal presentation because I'm working on my pitch deck too. If you come back on the 59th day and say, Gene, I'm ready. Can we meet? This is what I did. All of a sudden, you're a standout because you told me what you were going to do and you did it. And then the pitch deck, because you've already done that, that means you're a smart guy and you know how this works. The pitch deck is very, very good, and you have a compelling story, and you have the team, and you say, look, it's all here, right? So what's a perfect pitch? Do I have a second to tell you what the perfect pitch is?
Yeah, give us it, yeah. We're going to go over the end of the hour, so this is great. We got at least 2 more questions for you. So.
Oh, God, I could go for hours.
This is great.
As anyone who knows. So here's a perfect pitch that we heard. This was a 99.9% pitch that we heard.
Was this one of the two? Or?
This is one of the two.
Okay, this is one of the two. Here we go. Get ready for it, folks.
We heard this a couple of months ago. Guy says, I am a mechanical engineer, and I worked with a very large Dow 50 company, Dow Jones 50 company, and Forbes 50 company. The company was Dow. There it goes. Forbes 50 company, and I built this device, and my company invested $70 million. Company merged, and the merged entity says, we don't want to be in this business. I got the asset for pennies on the dollar. I have now built version 2, and it works better, and it's cheaper, and it's a recurring revenue model. And my former top customer is now my new partner. And we have the list of all the customers we're going to sell to. We're ready to take your money. Great. Where do I sign up?
Wow.
Fantastic pitch.
Yeah.
I've done it. I know my market. I have my team members. I have white space. I have patents. And I already know the market works.
Wow.
Fantastic.
That's huge.
It's gorgeous. Deal got done immediately. And in terms of diligence, we had this go in front of our angel group, all 180 members. One guy said, yeah, I was that guy's boss. And he was right. And we did put that money in, and I'm writing my check. When the guy's boss says, I'm writing my check, he says, yep, that's real. It was a beautiful deal.
That's amazing.
It breezed through diligence, right? Because the value of the network was the most informed person in the world that would know about that particular technology was at the table as one of our investors. Not going to get that in a family office unless you were that guy.
Yes. Yeah.
Right. So that's the kind of value that this cohort brings together. Just fantastic.
That was an amazing story. That must have been a really joyful moment for you guys.
Well, it will be most joyful when we exit.
When we exit. That's the goal. There you go.
So, I mean, but that was good. That's just really good stuff.
It kind of strikes me that what we're putting a finger on here is The best pitch is one that shows a prior track record, and if you haven't made the pitch yet, you still have a chance to show a prior track record.
Sure, sure. If you say, I have translational skills, I was a designer of XYZ, and I happen to be able to move this into medical devices, right? Okay, I can see that. And somebody else comes in and says, I ran a company that did this very thing. Okay, you're not going to have one person that can do everything,
Yep.
right? Those people don't exist. And so when you have 2 or 3 people that come together and they say, you know, by the way, we really don't have a good finance person yet. Fine.
Mm-hmm.
Our network,
We can find you one.
bingo,
Yep.
we can find you that person.
Yeah.
So don't assume that you have to be, you know, Mark Zuckerberg,
Yep.
right? You don't. Plenty of people that can make up a Mark Zuckerberg
Yeah.
or an entire team.
That's really cool. I want to take you back to the safes for just a second, because another question came up there. Are safes, because I know that there have been a lot of, was it Y Combinator that was part of getting those really big and stuff like that?
Yes.
So you got these big or flashy organizations out there, and they're pushing this, and it, like you said, it does make it easier on the startup, and maybe even favorable to the startup, and now it just gives us a piece of it, and you know, we can take that risk. Is the prevalence of those making it harder on angels? Is the fact that some of these entities out there can sort of afford to be a little willy-nilly, not get the best deal for themselves, does that make life harder on the angels?
Well, it can, for sure. If you think about why safes came into being, it may shed some light. So if you think about the coastal investing ecosystems, right? So Boston, San Francisco, maybe Austin, tremendous competition for deals, right? So you have lots of money chasing a few deals, relative, right? So if you're an entrepreneur, you get company-friendly terms. So that's how these things started. So some clever lawyer, maybe at Y Combinator or wherever, said to the entrepreneur, look, if you want a better deal, we can structure the deal better. Here's how you get it. Well, all of a sudden that became sort of the way. Well, everyone's doing is safe. So the pendulum is shifted over to company-friendly terms. Now, it will certainly shift back and then it'll settle sort of in the middle over time. But what's happened is we've gotten to very company-friendly terms on the coast, and it's percolating to the Midwest in the default is, well, that's just how everyone's doing it.
But at some point, these are going to come mature. People are going to realize on the investment side that maybe these weren't always the best deals, and there'll be some pushback.
I think there will be. I think there will be. And one thing that you've seen is the elimination of participating liquidation preferences, which means when the company sells, I get my bait back. Right, before, you know, I give you $2 million, that comes off the top, and then we start talking about the conversion and the pro rata rights and all that sort of stuff. That's gone away now. It's now terms are the greater of 1 times your investment, or if you convert into a common stock with everybody else. That's sort of where market is, and it'll probably swing back and forth as it always does.
As it goes, it's always a dynamic process. Yeah.
That's right.
Dale, I want to take you to the bottom line. Returns. Everyone wonders, what are the returns in angel investing? And to disabuse anyone, if you make one investment, your return is, by all rights, probably going to be 0. Just rolling the dice there.
That's right.
But over time, if you do this well and you're looking at sharing the knowledge in a group like this, and you've got some time behind you to really learn the process and do it well, what should an angel hope for?
The way that returns are measured in the industry are by quartiles, right, compared to your peers. So angel investing is a little bit different because what you see is a natural skewing because of the coast. So you see valuations are much higher for early stage investing, pre-money values. But what you ought to be able to expect over a period of time, a good internal rate of return, which includes time value of money, ought to be in the low to high 20s. 20 to 29% a year. That means you ought to be getting over time 2 to 3 times your money, right? That's sort of where it sort of matures out. And funds are measured according to quartiles, top fourth, second, fourth, third, and bottom. Proud to say that the MCN funds are in the top quartile in terms of distributed return funds. So we're very proud that we've done what appears to be a good job as compared to all of our peers nationally. So that's sort of one turn up when you have managed funds as compared to individual investments. But by and large, expect that you're going to get, 20% is, I think, a reasonable number if you are consistent and you've invested in, let's say, 20 deals over at least 4 years, because you take out economic risk, and you also get to the power law of, once you get to 20, the chances of going all the way to zero collectively sort of go away. That's what the power diversification does. So if you get there, you're probably in very good stead, right? But the temptation, of course, is to say, I really know about software services, so I'm only going to invest there. That creates concentration risk, right? What you really ought to be doing is a little bit of everything, right? Because now you're creating non-correlative risk. You're outside of the market, public-private, and you're outside of any one industry, right? That's what a balanced portfolio approach looks like. Probably ought to be in gold, probably ought to be in lumber, probably ought to be in crypto, probably ought to be in life tech, health tech, fintech, but cosmetics, sports, whatever. You ought to be all over the map, because at some point, something in your portfolio is going to be up and something's going to be down. That's how it works. We're up and down, right?
Yeah.
That's how that works.
Yeah, that's interesting. So 20% would be what we're shooting for, and hopefully a reasonable return. But of course, people all over the place, and that's where you got to look at the group that you're working with.
That's right.
What are their track record? What are their results? Let's see if the tech works to do this. We've got a question online from Kevin McLeod, who has been on the show before, obviously with C2DX.
He's going to ask a tough question.
Is he going to ask a tough question? Should I not let him on? No,
Can you filter it first?
I can't, and with Kevin, I really can't do that.
Kevin has no filter.
Kevin, let's see if Steve can bring Kevin live for us.
Are you guys done?
I could go on.
I know you could. Dale, great to see you. And great hour with you. I appreciate your time. I'm just curious, are you guys seeing, considering what's happened with in the last 2 years and where supply chains are right now, are you guys seeing an extension to some of your assumptive exits? Are some of the dates getting pushed out, or how's it looking?
Certainly so in spaces like life sciences and those that are affected by COVID, right? So clinical trials, as you probably know, have been extended, right? We're now back into the clinic.
Yep.
You certainly see that in devices. Kevin, I'm sure you're living that with being able to get parts. Costs have just gone through the roof, and that's across the board, right? So just the supply chain, as you say, Kevin, is sort of one of those unknowables, right? We just can't plan for if we can get glass, right? Sterile vials, for example. I mean, those, you would think you can get them, hard to get.
Yeah.
And everyone's competing, so prices go up and up and up. So yeah, it's tough. I can't tell you when it's going to lessen, but it sure feels like we still have, some headwinds for the next 3 to 6 months. Would you say that, Kev?
Yeah, certainly. And I know where we are, and of course we're still fairly young and working on our 4th year, but just seeing the startups and how it's affecting them and your timelines is just curious. Yeah, I agree wholeheartedly with your comments.
Yeah. Great, Kevin. Really appreciate your
congrats, Dale. Good to see you.
Yeah. Thank you.
Take care, friend.
Thank you, Kevin. Always good to have you. Dale, we're going to leave you with the last word today. Really appreciate your being here, educating us about angel investing. And I guess speak to the 2 groups for me. First of all, to the potential angels, somebody out there who thinks, yeah, I'd like to get into that high-tech, high-risk stuff. And then to the startup that says, I'm trying to do this. I'm not sure when I'm ready for angels. I think I might want to start moving in that direction.
Fantastic. to the angel or budding angel investor, I would say get in the game, right? Just start. There's no secret sauce. It is a game of experience. I would not put all of my money in the first deal at all. Just put your toe in the water. Join an angel group for sure. If you've never done this before, join an angel group because there are a lot of really smart, seasoned investors sitting next to you that you can rely on their experience. And you can probably avoid a lot of early investor pitfalls, right? So just start. Be consistent and recognize that it's not always going to go how you anticipate. In fact, it never does, right? So just know that it's a circuitous path from A to B to Z, and just be patient. But if you invest with good people that are smart and willing to work with you and for you, then that's as good as it's going to get. As an entrepreneur, recognize that your investors want to help. They want you to succeed. They are invested. They are aligned. They are your cheerleaders. Use them, right? Your investors are well connected, particularly angel investors. But also recognize that they have certain expectations. When you show up and you make a pitch, you must recognize that they have a different perspective and honor that perspective and be able to see that perspective come across the table to their chair. If you can do that successfully and you can sit in their chair and understand what is expected, the relationship can go fabulously
You're going to
well.
have some pretty happy investors at that point.
Right. Be transparent and deliver the bad news early.
Yes.
Do not sit on bad news. Boy, that's the worst thing that can happen.
Get it in there. Let them see what it actually looks like.
Own it. We missed the market. We thought it was going to be left, and the market went right. But we're ready to go right. Here's how we do it.
And our team is ready to do that. I love just one thought there. I just want to repoint that out. Your 3 points to the pitch, really, right? It's the team, it's what's the problem we're solving, and it's how are we going to solve it and execute on it.
That's it.
It's a pretty simple pitch deck. We often talk about 10 parts to a pitch deck or whatever, and you've got it down to 3, which I think is really, really cool.
I'm a simple man.
Dale Grogan, thanks for being with us.
Oh, what a treat. Thank you for having me.
And thank you for being with us today. We appreciate having you all here. Next week's going to be a special episode. Before we continue with our early stage funding series, we'll continue on with that the week after next. But next week, we're going to have a special episode where we take you all around MD&M West, Medical Device and Manufacturing West. And hey, since we're there, if you have any questions about vendors or what's going on there, feel free to shoot them to us. You can shoot them to info@intobeing.com, and we'll be happy to track down anything that's of interest on that show floor. So, hope you have a great week. We'll talk to you soon. Bye-bye.